Yes, people, good morning, good afternoon, good evening to all South India students. How are you? Hope so you are well. I am also good. So today we are going to start with the revision lecture of the transfer pricing topic, and this topic is very interesting, and this topic will cover approx 10 to 15 marks in your paper number 7. So in your paper number 7, this topic will cover approx 10 to 15 marks. So I can say that this topic is very important for your examination. And if you have opted the paper number 6C also, that is elective paper, in elective paper weightage is 30 marks. Means 30 marks this topic will cover in the elective paper 6C, that is international taxation. So we are going to start with the transfer pricing. Transfer pricing charging section is 92. Now 92 is the charging section of this topic. This section says that 92 says that if there is any international transaction between associate enterprise, then you have to compute that transaction at arm length price. Means you have to bring that transaction at arm length price. So all people just pay attention. First part is a international transaction. If there is an international transaction between associate enterprise, then you have to compute the income in accordance with the arm length price. Now question is that, sir, what is the meaning of the international transaction? So international transaction is defined in section 92B. 92B is related to the international transaction. Now 92B says that international transaction means transaction between two or more associate enterprise, and at least one should be non-resident. That is called your international transaction. What I am saying that international transaction means transaction between two or more associate enterprise, and at least one should be non-resident. That is called your international transaction. I can take one example. Suppose if there is a transaction between one resident and another resident, is that is treated as international transaction? Answer is no, it is not an international transaction. But suppose transaction is between resident and non-resident, it will be treated as international transaction? Answer is yes. One more thing, suppose there is a transaction between one non-resident and another non-resident, it will be treated as international transaction? Answer is yes, it will also be treated as international transaction. Now you may ask a question, sir, here there is a transaction between one non-resident and other non-resident, then why it is treated as international transaction? Why transfer pricing is applicable? Guys, suppose out of this two non-residents, suppose any one non-resident income is taxable in India, then it will be treated as international transaction and transfer pricing is applicable. Now question is that, sir, what is the meaning of transaction? Transaction means either it is a sale transaction, purchase transaction, provision of the service transaction, as well as the allocation of the cost transaction. Now what is the meaning of the allocation of cost? Allocation of cost means, I can take one example. Suppose there is a one Unilever group. Unilever group, one holding company is located in the UK, that is the UK Unilever Limited. Suppose UK Unilever Limited develops some product, and what happened, they spend on the development of product. So obviously they will charge some cost from every company, every group company, like all the subsidiary company, or I can say that group company will pay the development cost. So this allocation of cost, that should also be on the arm length price. That allocation of cost should also be on the arm length price. You got my point or not? Yes. So what I am saying, that first part is a transfer pricing. When transfer pricing is applicable? So transfer pricing is applicable if there is an international transaction between associate enterprise, then you have to calculate that transaction regards to the arm length price. Now question is that, what is the meaning of international transaction? We already discussed that international transaction means transaction between two or more associate enterprise, and at least one should be non-resident. That is called your international transaction. Now question is that, what is the meaning of associate enterprise? Associate enterprise means, you can say that the two close related enterprise. If there is a love between two enterprise, then both enterprise will be treated as associate enterprise. So associate enterprise is defined in section 92A. So we are going to discuss the section 92A. 92A is related to the associate enterprise. So associate enterprise, they have given the certain relationship. If any one relationship is exist at any time during the previous year, then both enterprise will be treated as associate enterprise. First clause says that, suppose one enterprise hold 26% or more equity shareholding of the another enterprise. Means one enterprise hold 26% or more equity shareholding of another enterprise, then both enterprise are treated as associate enterprise. I can take one example. Suppose there is a one company name is A Limited, and A Limited holds suppose 26% or more equity shareholding of the B Limited. In that case, A Limited and B Limited Limited, both are associate enterprise. Both are associate enterprise. Now, second point says that suppose one person or one enterprise hold 26% or more equity shareholding of or voting power of the two enterprise, then both the enterprise will be treated as associate enterprise. I can take one example. Suppose here in this example, A Limited hold 26% or more equity shareholding of the B Limited, as well as the A Limited hold 26% or more equity shareholding of the C Limited. In that case, obviously this A Limited and B Limited are associate enterprise due to the point number 1. Here A Limited and C Limited are treated as associate enterprise due to the point number 1. But guys, point number 2 says that here B Limited and C Limited will also be treated as associate enterprise. What I am saying that B Limited and C Limited will also be treated as associate enterprise. So 2 clauses we already discussed. First point says that if any one enterprise hold 26% or more equity shareholding of another enterprise, both are treated as associate enterprise. Or if one enterprise or person hold 26% or more of equity shareholding or voting power of the both enterprise, then both enterprise will be treated as the associate enterprise. You got my point or not? Yes. Third point says that suppose one enterprise appoint more than half of the board of director or one executive director of another enterprise, then both enterprise will be treated as associate enterprise. I can take one example. Suppose there is a one enterprise, name is a X Limited. Now guys, X Limited appoint more than half of the board of director or one executive director of Y Limited, then X Limited and Y Limited will be treated as associate enterprise. Now more than half of the board of director means I can take one example. Suppose Y Limited is having total 7 director, and out of 7 suppose 4 director are appointed by the X Limited, or suppose X Limited appoint at least one executive director. Executive director means full-time director or full-time director, that is called your executive director. In that case, X Limited and Y Limited will be treated as associate enterprise. One more point says that suppose if one person appoint more than half of the board of director or one executive director of the two enterprise, then this two enterprise will be treated as associate enterprise. So suppose X Limited is also appoint more than half of the director of the Z Limited. In that case, Z Limited and Y Limited will be treated as associate enterprise. In that case, Z Limited and Y Limited will be treated as associate enterprise. You got my point or not? Yes. Now next part, all people just pay attention. Suppose one enterprise gives loan to the another enterprise, loan or advances to the another enterprise, and that loan amount is more than 51% or more of the total asset of other enterprise, then both enterprise will be treated as associate enterprise. I can take one example. Suppose there is a one enterprise name is a A Limited, there is another enterprise name is a B Limited. Now A Limited is giving loan to the B Limited and loan amount is suppose 600 crore, and here B Limited book value of total asset is a 1000 crore. So here that 60% of total asset or loan is given by the A Limited. It means here it is a 51% or more is loan given by one enterprise, then both enterprise will be treated as associate enterprise. So in this particular example, A and B Limited will be treated as associate enterprise. One more point says that suppose one enterprise borrow money from the market and other enterprise gives the guarantee of at least 10% or more of the total borrowing. In that case, both enterprise will be treated as associate enterprise. I can take one example. Suppose there is a one company name is a Bala Limited and there is a one company name is a Obama Limited. Now Obama Limited borrowed total 100 crore from the market, and here like Bala Limited gives the guarantee of 10% of the total borrowing, at least 10% or more of the total borrowing. In that case, Bala Limited and that Obama Limited both will be treated as the associate enterprise and transfer pricing is applicable. Now next point says that suppose one enterprise business is totally depends on know-how, patent, copyright, trademark, franchise, design, formula of the another enterprise, then both enterprise will be treated as associate enterprise. I can take one example. Suppose in India there is a one company name is a Hero Limited. In Japan there is a one company name is a Honda Limited. Suppose Hero Limited like acquiring know-how from the Honda and Hero Limited total businesses depends on the know-how of the Honda. In that case, Hero and Honda both will be treated as associate enterprise. Hero Limited and Honda Limited both will be treated as associate enterprise. Transfer pricing is applicable. One point says that suppose any one enterprise require raw material and raw material requirement, total raw material requirement, out of that 90% or more material is supplied by one enterprise. Means whatever raw material requirement out of of that 90% or more raw material is supplied by any one enterprise, in that case both enterprise will be treated as associate enterprise if that other enterprise influence on the price and all. So what I am saying that whatever your total raw material requirement, out of that 90% or more raw material is supplied by such other enterprise, and such other enterprise influence the price and all, in that case both enterprise will be treated as associate enterprise. Now guys, one point says that suppose one enterprise manufacture the goods and that enterprise sell goods to the another enterprise, and that another enterprise influence on price. Means price is decided by buyer here. Here price is decided by buyer. In that case, both enterprise will be treated as associate enterprise. One point says that suppose one enterprise is controlled by any individual. One enterprise is controlled by individual. I can take one example. Control means 26% or more equity shareholding and all, that is called your control. So suppose one enterprise is controlled by one individual and another enterprise is controlled by individual or relative of such individual. In that case, that both enterprise will be treated as associate enterprise. I can take one example. Suppose I am holding 40% shareholding of the X Limited and my wife is holding 60% shareholding of the Z Limited. In that case, that X Limited and Z Limited both will be treated as associate enterprise. One more point, suppose one enterprise is controlled by the HUF and other enterprise is controlled by that member or relative of such member of HUF. In that case, both enterprise will be treated as the associate enterprise. You got my point or not? Yes. Now guys, always remember that in case of the partnership from AOP BOI, that 10% or more PSR, then both will be treated as associate enterprise. I can take one example. Suppose my company name is a BB Virtuals Private Limited. Now BB Virtuals Private Limited holding 12% PSR in the Dubai-based one partnership firm. So is that partnership firm and my company will be associate enterprise? Answer is yes, both will be treated as associate enterprise. So normally in case of company and all, 26% or more equity shareholding is required. But in case of the partnership firm AOP BOI and all, if there is a 10% or more PSR, in that case both will be treated as associate enterprise. You got my point or not? Yes. Now guys, all people just pay attention. What I have discussed till now, like international transaction means transaction between two or more associate enterprise, then two or more associate enterprise. In that case, it like transfer pricing is applicable. Now guys, there is one more concept that is known as the deemed to be international transaction. Deemed to be international transaction means transaction is not between associate enterprise. Here a transaction is between one person and like transaction with the outsider, but your associate enterprise is influence on the price, means your associate enterprise is decide the price of that transaction. In that case, or terms and condition of that transaction, in that case that transaction will be treated as deemed to be international transaction. I can take one example. All people just pay attention. Suppose there is a one company name is a X Limited and there is a one company name is a Y Limited. Now this X Limited and Y Limited both are associate enterprise. This both are associate enterprise. Now what happened? Here this X Limited is like X Limited is going to enter into one transaction with the unrelated party, that is A Limited. So obviously, whatever transaction between X Limited and A Limited, that is not an international transaction, because international transaction means transaction between two or more associate enterprise. Here this A Limited is not an associate enterprise, but guys, related to this particular transaction, if there is a prior agreement between A Limited and your associate enterprise, that is Y Limited. If there is a prior agreement related to this transaction between A Limited and Y Limited, and here Y Limited influence the price, Y Limited decide the terms and condition of this transaction, in that case guys, this transaction will be treated as deemed to be an international transaction. This transaction will be treated as deemed to be an international transaction. You got my point or not? Yes. Now we are going to start with next part, that is computation of arm length price. Next part is a computation of arm length price. Sir, how to compute the arm length price? Because if there is an international transaction between associate enterprise, then you have to calculate your transaction value at an arm length price. Now question is that how we will calculate the arm length price. So for arm length price calculation, as per section 92C, there are five methods. You have to choose the most appropriate method. You have to follow the most appropriate method, means best method out of this five method that is suitable for your transaction. So first method known as the comparable uncontrolled price method, or I can say that the CUP method, comparable uncontrolled price method. Just you have to focus the name of the method, that is comparable uncontrolled price method. So suppose in your case, suppose if any comparable transaction is available, comparable and uncontrolled transaction is available, then just take whatever price charged or paid in that uncontrolled transaction, that price will be your arm length price. I can take one example. Suppose there is a one company in India, name is X Limited. Now X Limited selling some goods to the Y Limited, and suppose X Limited and Y Limited both are associate enterprise. So whatever transaction between X Limited and Y Limited, that will be treated as the controlled transaction, or I can say that the international transaction. So here you have to check the uncontrolled transaction. So suppose X Limited is selling similar goods to one company, that is the Z Limited, and here Z Limited is outsider, then whatever price charged from Z Limited, whatever price charged in this particular transaction, that price is known as the uncontrolled price. So just take that uncontrolled price and calculate your arm length price. So first, in this particular method, you have to take the price charged or paid in the comparable uncontrolled transaction, and after that, if there is any functional difference between both the transaction, there may be a functional difference between both the transaction, means transaction with associate enterprise and transaction with outsider. If there is any functional differences, then just make the adjustment of that functional differences, you will get your arm length price. So guys, this particular method is applicable when comparable uncontrolled transactions are available. So if comparable uncontrolled transactions are available, then this particular method is applicable, that is called CUP method. Now next method is a resale price method. When resale price method is applicable? Resale price method is applicable when you are engaged in, means our Indian enterprise is engaged in the distribution function. If they are doing the distribution function, in that case resale price method is applicable. Means normally we import some goods from the associate enterprise and we are selling to the outsider, means importing or purchasing goods from associate enterprise and selling to the outsider. In that case, this particular method is applicable. Now question is that how to calculate the arm length price. So in resale price method, just start with the resale price. Whatever your resale price, just first take the resale price, and from resale price just minus the gross profit margin. Whatever the normal GP margin in the similar transaction, just reduce that normal GP margin, and after that, if there is any purchase related expenditure, just reduce that purchase related expenses, you will get your arm length price. Guys, always remember one thing, in computation of arm length price, always calculation of arm length price will be started from untainted price. Untainted price means non-biased price, I can say. I'm sorry, that is the non-biased price. Yes. So untainted price, always start your computation of arm length price with the untainted price, because here you are purchasing goods from associate enterprise and selling to the outsider. So obviously when you are selling to the outsider, so here your sale price is untainted, sale price is unbiased price, or I can say that true price. So always your arm length price will be started, calculation will be started from the untainted price. So here you have to take the resale price minus your normal GP margin minus purchase related expenses, you will get your arm length price. Now next method is related to the cost plus method. Now this particular method is applicable normally in the software industry and all. When Indian enterprise is manufacturing software and they are selling that software to the associate enterprise, when they are selling that software to the associate enterprise, then this particular method is applicable, that is called cost plus method. Now guys, in this particular method, obviously your untainted element is a cost. So first take the cost, whatever your direct cost and indirect cost, just take that cost, that is your untainted element, and in that total cost just add the normal GP margin in the similar transaction, you will get your arm length price. So what I'm saying, that cost plus method, just take the cost, total cost plus your normal GP margin, you will get your arm length price. But suppose your normal GP margin you are taking in this particular transaction, suppose your normal GP margin in uncontrolled transaction, and here it is a controlled transaction, there are some functional differences, then obviously you have to make the adjustment in your GP margin, and after that you have to take the rectified, or I can say that the corrected GP margin. For this purpose you will get your arm length price. Now next method is a profit split method. From name only you can understand that profit split method. Now this particular method is applicable when associate enterprise execute any job in the joint venture. So suppose there are three companies, that is A Limited, B Limited and C Limited, they enter into the joint venture and they are suppose manufacture or produce some software in the joint venture, and there is a joint profit. So question is that how we will split that profit. Here at that place this particular method is applicable. Now in profit split method it's very simple. First calculate the total profit. Whatever total profit, just first calculate the gross profit, or I can say that the total profit in that particular transaction, and after that, that total profit will be bifurcated or divided between the enterprise in their contribution ratio. Contribution in terms of the capital employed, risk assumed, as well as the manpower engagement, and also in the joint contribution ratio, whatever their contribution ratio, in the contribution ratio you have to divide the profit and you will get your arm length price. You got my point or not? Yes. Now next method or last method is known as the transactional net margin method. Now this transactional net margin method is very simple. Just take the net profit of the similar enterprise. I can take one example. Suppose our enterprise is engaged in software development, then we will check that similar enterprise is the TCS as well as the Wipro, as well as the suppose for an example, there are various companies, they are engaged in the software manufacturing. So we will check that what that company is charging the net profit. That net profit we will also charge similar net profit, that is called your net profit net margin, that is TNM, and transactional net margin method. So we have discussed till now there are 5 methods. So 5 method. First method is a CUP method, that is comparable uncontrolled price method. Whenever comparable uncontrolled price is available, you have to follow that method. Second is a resale price method. Resale price method is applicable when you purchase something from your associate enterprise and selling to the outsider. Cost plus method, when you are selling to your associate enterprise, then obviously your untented element is a cost. So just take the total cost plus profit, you will get your arm length price. After that, profit split method is applicable when joint venture is there. So suppose if there is a joint venture, in that case what happens, just calculate your total profit. First calculate your total profit, and after that, that profit should be distributed amongst the associate enterprise and in their relevant contribution ratio. Contribution ratio means in terms of the capital employed, risk assumed, manpower engagement and all. Depends on that, just split the profit, that is called your profit split method. And last method is a TNMM, that is transactional net margin method. In this method, just take whatever net profit charged by the similar enterprise in the same industry, that net profit you will also charge in your international transaction, or I can say that the control transaction, that is called your methods of calculation of arm length price. Now we are going to start with the next part, that is a 92C subsection 2, and this section says that suppose from one method you got more than one arm length price. Suppose one method, what I am saying that from one method, you are following the CUP method, but from CUP method, you got the 5 uncontrolled transaction price. So there are 5 arm length price. So suppose if you are having more than one arm length price, then what you will do? So guys, if you got more than one arm length price, in that case, you have to take the normal average. You have to take the normal average, or I can say that the simple average. So suppose here there are the 4 arm length price, 145, 152, 157, 160, and your international transaction price is 150. So here there are 4 arm length price. So first I will do the average. So here my average comes to suppose 153.5. Here my average comes to 153.5. Now guys, here remember one very interesting part. Here this section says that whatever your actual transaction price, means this price, and average arm length price, if this difference between this two price is up to 3%, if difference between average arm length price and actual transaction price is up to 3%, in that case your average arm length price should be ignored, and your actual transaction price will be treated as the arm length price. What I am saying that all people just pay attention. Suppose difference between your actual transaction price and average arm length price is up to 3% of actual transaction price. Means you have to calculate that 3% of the actual transaction price. So you have to calculate the 3% of actual transaction price. So here 3% comes to 4.5. Here our difference is only 3.5. Here difference is 3.5. This is called your tolerance band, or in the practical life in office it is known as the plus minus 3%. So if difference is up to 3%, that is up to 4.5, in that case here your 150 will be treated as your arm length price. So and suppose difference is more than 4.5, suppose here it is a 157.5, in that case difference is 7.5, that is more than 4.5, in that case your 157.5 will be treated as your arm length price. You got my point or not? Yes. Now one more point, all people just pay attention. In case of the wholesale trading, this 3% tolerance band will be reduced to 1%. So in case of wholesale trading, you have to take the 1% as a tolerance band. But now question is that what is the meaning of wholesale trading? So wholesale trading means if 2 conditions are satisfied. First condition says that purchase cost of finished goods is 80% or more of total cost pertaining to such trading activity. Means out of your total cost, purchase cost of goods should be 80% or more. Means at least 80% or more of your total cost should be a purchase cost. That is the first condition. And second condition says that average monthly closing inventory of such goods is 10% or less of sale pertaining to such trading activity. Means every month, average monthly closing inventory means closing stock, means monthly closing stock should be the 10% or less of the sales pertaining to such trading activity. Means whatever your sales pertaining to such trading activity, means out of that sale activity, your average closing stock at the every month end, it should be 10% or less. Then you will be treated as the wholesale trading, means you are engaged in the wholesale trading business. You got my point or not? Yes. Now next section is the 92C subsection 3, that is related to the determination of arm length price by the assessing officer. Normally you know that you calculate the arm length price and you will file the TP study report and all. So normally you calculate the arm length price, but guys, there are 4 cases. In these 4 cases, your assessing officer will calculate the arm length price. Assessing officer will calculate the arm length price. First case is, suppose assessee fails to follow the most appropriate method. Means assessee has not followed the most appropriate method. Means as per assessing officer, suppose assessing officer think that here cup method should apply, but suppose you followed the RPM or like resale price method, or you followed the cost plus method or TNMM method and all. So what I am saying that you have not followed the most appropriate method. That is the first case. Second, data used in the computation of arm length price, that is not correct or reliable. Means whatever data you use in the practical life, you know that we use normally Provis and capitalized database. So Provis and capitalized database, that is basically CBDT accept that database. But suppose you followed some other database and all, and that database is not reliable or correct. In that case, your arm length price will be determined by assessing officer. Third part, suppose you have not maintained any documentation, because if your international transaction is more than 1 crore, you have to maintain the TP study report and all. But suppose if you have not maintained the TP study report, in that case. And fourth, suppose you maintain the TP study report, but you have not submitted that TP study report to the assessing officer or department. In this 4 cases, like assessing officer can determine your arm length price. So all people just pay attention. 92C subsection 3 says that okay, there are 4 cases. In this 4 cases, your arm length price will be determined by assessing officer. First, most appropriate method is not followed. Second, data used for the computation of arm length price, that is not reliable or correct. Third case, documentation is not maintained by assessee, or documentation maintained but not submitted to income tax department. In this 4 cases, your arm length price will be determined by assessing officer. Now next section is 92C subsection 4, and 92C subsection 4 says that okay, suppose your assessing officer determine your arm length price, then what will be the effect of that? There are very interesting part, all people just pay attention. First effect says that okay, whenever assessing officer determine your arm length price and assessing officer increase your income, then against increase part of that income, you cannot claim any deduction under chapter 6A or deduction under section 10AA. I can take one example. Suppose what happened, you have filed the return of income, and as per ROI your income was 100 crore. Suppose there was some deduction under chapter 6A, suppose there was deduction of 80 IAC, and that IAC deduction was, suppose for an example, 50% was deduction, so 50 crore you claim the deduction for an example. This is not a 50% in a 80 IAC, but this is only for the purpose of example. So here your net income is 50 crore, means your net taxable income was 50 crore as per your return of income. Now what happened? Assessing officer determine your arm length price, and assessing officer increase your income to the 130 crore. So normally, logically, you should get the 50% deduction on 130 crore. So 65 crore should be deduction, but no guys, no. Here you will get the deduction of 50 crore only, and 80 crore will be your total income. So in simple word, I can say that okay, whenever assessing officer determine your arm length price, then against the increased part of that income, you cannot claim any deduction under chapter 6A or deduction under section 10AA. One more point. Suppose assessing officer calculated the arm length price for one assessee, and that transaction was related to payment, and this assessee like deducted the TDS and all, and they changed the expenditure. So question is that other person income will change or not? Answer is no. I can take one example. Suppose in India there is a one company name is a Hero, and there is a one company name is a Honda. Now what happens? Suppose Hero paid royalty to Honda of 200 crore. Suppose Hero paid royalty of 200 crore to the Honda. So Hero paid 200 crore royalty to the Honda. Now here what happened? Okay, here they deducted the TDS at the rate 10%. So 20 crore TDS was deducted by Hero and paid to the government. Now what happened? Obviously royalty is a cost for the Hero. So here they debited 200 crore as a royalty as a cost, but assessing officer like imposed 92C subsection 3 and assessing officer is saying that I will not allow 200 crore. Here your royalty should be 150 crore. So here in case of the hero, assessing officer calculated the arm length price. Here assessing officer calculated the arm length price and assessing officer is saying that okay, here your expenditure should be 150 crore. Now question is that okay, only 150 crore expenditure is allowed to hero. Can Honda claim only 150 crore as income? Can Honda argue that okay, since 150 crore is only allowed to hero, so our income should be only 150 crore and whatever TDS deducted that 20 crore out of that 5 crore TDS should be reimbursed to us and all. Can they claim income as 150 crore? Answer is no. That is given in section 92C subsection 4. So 92C subsection 4 is applicable only when assessing officer compute your arm length price. First, against income increase, you cannot claim any deduction under chapter 6A or under section 10AA. And second point says that if any expenditure is changed, in that case, whatever receiving person, that income will not change, that income will intact. You got my point or not? Yes. Now we are going to start with one very interesting part, that is the range concept. Yes, people. Now, next part is related to range concept. Now, all people just pay attention. In section 92C subsection 2, we have discussed that okay, if there is a more than one arm length price, then you have to take the average. But guys, try to remember this particular concept. This concept says that okay, suppose in four method, which four method? First is a cup method, that is comparable uncontrolled price method, or resale price method, or cost plus method, or transactional net margin method. So in simple word, can I say that other than profit split method? So other than profit split method, in case of this four method, if arm length price from most appropriate method, if arm length price is 6 or more, if arm length price is 6 or more, then range concept is applicable. Means if arm length price is 1, 2, 3, 4, 5, in that case, obviously that concept we already discussed, that just take the simple average, after that plus minus 3%, that tolerance band, that is applicable. But suppose if your arm length price is 6 or more, in case of this four method, that is cup, resale price method, cost plus method and TNMM, in that case range concept is applicable. Now question is that, okay, sir, what is the range concept? How to calculate arm length price in range concept? So all people just pay attention. Suppose we are going to take, suppose we can take one example. All people just pay attention. Suppose in this example, your actual transaction price is 150. But suppose you got the arm length price, that is the 7 arm length price. So here arm length price is 162, 158, 136, 145, 170, 152 and 154. So there are total 7 arm length price in our data set. So if this arm length price is 5 or less, then 92C subsection 2 is applicable, means normal average, and after that plus minus 3% tolerance band. But 6 or more, then range concept is applicable. So here we have to follow the range concept. Now what is the range concept? How we will calculate the arm length price? So there are some steps. And first step is just arrange this arm length price in the ascending order. That is your first work. Means first step is arrange this arm length price in the ascending order. So all people just pay attention. Now I am arranging this price in the ascending order. So smallest number is 136. So first is 136, 145, 152, 154, 158, 162 and 170. That is the ascending order. That is your first work, or I can say that the first step. After that, like in this data set, there are total 7 number. First take the 35 percentile of total number, 35 percentile, and after that take the 65 percentile. So in here there are 7 arm length price. So first I will do the 7 multiplied by 35 percentile. So 7 multiplied by 35 percentile, it comes to the 2.45. Now guys, remember here, if any number is not a whole number, means 2.45 is not a whole number, you have to take the higher number, means here you have to take the 3 number. After that, take the 65 percentile of total values in the data set. So here total values in the data set is 6. So 6 multiplied by 65 percentile, it comes to 4.55, and here 4.55 is also not a whole number, so you have to take the 5. So guys, here from third to 5, you are getting one range. So from third to 5, this is the range, that is 152 to 158 is a range. Means you got one range between 35 percentile to 65 percentile, and that range is, in this range, your arm length price is 152 to 158. Now lawmaker says that, suppose your actual transaction price is fall within this particular range. Your actual transaction price is fall within this particular range. In that case, your actual transaction price is treated as arm length price. But suppose if your actual transaction price is not falling within this particular range, in that case, you have to take the medium of medium. You have to take the 50 percentile. So in our example, our actual transaction price was 150. Now we got the range. That range is between 152 to 158. Is 150 is falling within the range? Answer is no. If suppose our actual transaction price is 154, then obviously it is falling within the range. In that case, your actual transaction price is arm length price. But here your actual transaction price is only 150, that is not falling within this particular range. In that case, you have to take the 50 percentile, or I can say that the medium. Now how you will take the medium? So here your total number of total number in this data set is a 7. So you will multiply by 7 multiply by 50 percentile, it comes to the 3.5. Now guys, this 3.5 is a whole number or not? Answer is no, it is not a whole number. You will take the higher number, that is the 4, and against 4 that one price is given, that is 154. Now this 154 is called your arm length price. Now question is that, okay, sir, is that 3% tolerance band is applicable here? Answer is no, that 3% tolerance band is not applicable here. So all people just pay attention. How to calculate the arm length price in the range concept? So always remember that in case of the 4 method, that is cup method, resale price method, cost plus method, and transactional net margin method, if arm length price are 6 or more, then you have to follow the range concept. In that first, your first like a step is just arrange the arm length price in the ascending order. After that, take the 35 percentile of total number of values in that number of values given in that data set. So in our example, that was 7. So 7 multiplied by 35 percentile. After that, 65 percentile, and this is called your range. Now always remember that whenever you calculate the 35 percentile, 50 percentile, or 65 percentile, that number is not a whole number. You have to take the higher number, or I can say that the next number. So 2.45 or 3.55, 3.5 or that 4.55, that is not a whole number. Then obviously we consider the, instead of 2.45 we considered the 3, and 4.55, then we have to consider the 5. You got my point or not? Yes. So this is called your range concept. So if your actual transaction price is fall within the range, then actual transaction price is arm length price. Otherwise you have to take the 50 percentile. Now guys, suppose what I am saying that, okay, suppose whenever you calculate 35 percentile, 65 percentile, 50 percentile, that's not a whole number. You have to take the higher number. But suppose if that comes to the whole number, then for an example, in your data set total there are 20 values. So 20 values, 20 multiplied by 35 percentile, you will get 7. So 7 is a whole number. So you will consider the value given against 7 or not. Means here 7, that value is given is 119. You have to consider that value 119. Answer is no. No guys, no. It's not like that. Whenever that 35 percentile, 65 percentile, or 50 percentile, if you got the whole number, in that case you have to consider the average of value given against that number and the next number. Means you have to take the average of value given against that number and next number. So here it is a 7. So against 7 value given is 119, and against 8 value given is 120. So I have to take the average of 190 and 120. So average comes to the 119.5. From here my range will start. From here my range will start, and after that I will calculate the 65 percentile. Suppose 65 percentile comes to the 13. So 13 and 14, and I will take the average of the 132 and 135. That will be my range. You got my point or not? You understood my point or not? Yes. So whenever you calculate 35 percentile, 65 percentile, 50 percentile, that number comes to the whole number. In that case, you have to take the average of value given against that number and the next number. You got my point or not? Yes. Now all people just pay attention. Range concept is applicable in case of 4 method. I already explained you that range concept is applicable in 4 method. One is the cup, one is the resale price method, and one is the transactional net margin method, and CPM, that is cost plus method. But guys, remember, in case of 3 method, which 3 method? One is the resale price method, one is the cost plus method, and one is the transactional net margin method. In case of this 3 method, if multiple year data is given, then you have to take first weighted average data of multiple year. Means you have to take the 3 years weighted average data, and after that you have to follow the range concept. What I am saying, that all people just pay attention. In case of the resale price method, in case of the cost plus method, and in case of the transactional net margin method, in case of this 3 method, if multiple year data is given, multiple year means current year and last 2 year data, that is total 3 year data. If multiple year data is given, then you have to consider the weighted average. You have to take the weighted average arm length price, and after that you have to follow the range concept. You got my point or not? Yes. Now question is that how we will calculate the weighted average data. We will take the example, don't worry about that. Suppose our company name is X Limited. And suppose we are following one method, that is CPM. CPM is cost plus method. Now question is that how we will calculate the arm length price in cost plus method, or like profit in the cost plus method. So you know that in cost plus method, or resale price method, or transactional net margin method, always there will be a profit percentage. Because in resale price method, I explained that just reduce the GP from the selling price, or in cost plus method, just add the profit on your total cost, or on the transactional net margin method, just take the net profit margin of the other enterprise or similar enterprise. So always there will be a percentage. So suppose X Limited is our company, and we are following cost plus method, and we are charging suppose 15% profit from our associate enterprise on the cost. And how we calculated this 15%? So suppose our profit level indicator, PLI, profit level indicator, is our operating profit divided by operating cost. So suppose our operating profit of current year was 15 crore and our operating cost was 100 crore. So it comes to the 15%. Suppose our actual profit is 15%. Now it is an arm length price or not? So we will analyze our similar enterprise, what similar enterprise is charging on the cost and all. So guys, all people just pay attention. Suppose at the time of filing of return, what happened? There are 7 similar enterprise. One is the A Limited, one is the B Limited, C Limited, D Limited, E Limited, F Limited, and G Limited, or I can say that the comparable companies. So comparable companies there are total 7 comparables company. Now comparable company data is given. So for suppose current year A Limited, operating cost is 225 and operating profit is 35. Last year operating cost was 150 and operating profit was 10. Last to last year operating cost was 100 and operating profit was 12. So this data is given in relation to the A. So question is that, sir, how we will take the weighted average? So weighted average you will take just either like this profit percentage we calculated on the basis of the operating profit divided by operating cost. So first do one thing, just add that operating profit of all 3 years. Just add that operating profit of all 3 years and divide by, just add that operating cost. Means you are giving weight of the cost. You are giving weight of the cost. So here you're just add the 12, 10 and 37. It comes to 57, and just add the 100, 150 and 225, it comes to the 475. So here 57 divided by 475, it comes to the 12%. Now it is the weighted average arm length price. Now that 12% is a weighted average arm length price. Suppose in case of resale price method, normally we calculate profit divided by sales. So profit divided by sales, so just add 3 years profit and just add the 3 years sales, and you will calculate that will be your weighted average arm length price. So here 12% weighted average price of the A Limited, that is arm length price. From the comparable company is A Limited. B Limited 8.2%, C Limited 9%, D Limited 6%, 2.2%, 11.9% and 10.57%. So total here are 7 arm length price. So whenever your arm length price is 6 or more, then you have to follow the range concept. So first part, you have to arrange this price, arm length price, in the ascending order. So smallest value is 2.2%. So first 2.26, 8.29, 10.57, 11.9 and 12%. Now that same practice, do 35 percentile, 65 percentile, 50 percentile and all, that same practice you have to follow. So this multiple year data you have to use whenever there are three methods. One is your cost plus method, resale price method and TNMM, and in all three methods you know that there will be a profit percentage. So profit percentage will be always on the either on the cost or either on the like sales or on capital employed and all. So whenever that percentage is given, then you have to take the weighted average arm length price of the 3 year. You got my point or not? Yes. Now what happened? All people just pay attention. Now what happened? At the time of suppose you have filed the return. But what happened after filing the return, when assessing officer is when he was checking he was doing the assessment, and at the time of assessment, if assessing officer realized that assessing officer realized that at the time of assessment, what happened? Assessing officer realized that some company are not a comparable company in your data set. Or some new company, he got to know that some new company are comparable company. Then what he will do, you know that if any company is not a comparable company, he will remove from data set. And if any company, new company, and that new company is a comparable company, then he will consider that. So in what happened in this particular scenario, suppose earlier that company was A, B, C, D, E, F, G, H, G was like company. Now what happened? Assessing officer comes to know that here B is not a comparable company. So just he removed the B from the data set. Now there is a and C only. And he comes to know that there is a one company, that is a H company, that new company, and that company is comparable. Then obviously he will consider the data related to that company and calculate the arm length price. Now guys, what happened at the time of filing of return? Suppose some companies current year data is not available. In case of B company, current year data was not available. In case of D company, current year data was not available, but last year data was available. So whatever data is available, just consider that data. In case of the E company was new company, only current year data was available, last 2 year data was not available, no problem at all. Just consider the current year data. This is called your range concept. You got my point or not? Arey guys, tell me you understood my point or not? Yes. Now next part is related to the section 92 CA, and 92 CA is related to the reference to the transfer pricing officer. Now guys, in section 92C, subsection 3, I explained that in case of four cases, your arm length price will be determined by assessing officer. First is most appropriate method is not followed, or the data is not reliable, correct, assessee not submitted the documentation or TP study report, assessee not maintain the documentation and all. In case of that four cases, your arm length price will be determined by assessing officer. Now guys, question is that is assessing officer himself, he will calculate the arm length price? Answer is no. Normally he will transfer your case to the TPO. So whenever assessing officer think, he may transfer your case to the TPO. TPO is a transfer pricing officer, and TPO is an expert in the transfer pricing. He is a master in calculation of transfer price. So now your case may be transferred to the transfer pricing officer. So suppose if your case is transferred to the transfer pricing officer by assessing officer, but assessing officer can transfer your case to transfer pricing officer only with the approval of the CIT or PCIT. CIT means Commissioner of Income Tax or Principal Commissioner of Income Tax. Now your case is with TPO. Now TPO will gather all the evidences. He will ask you to submit some documentation and response and all. So whatever response you will give, he will also consider some evidences, documentation and all. And after that, he will determine your arm length price. Now guys, there is one question. Because suppose assessing officer referred only 3 international transactions to TPO, but when TPO was doing that work, that time he comes to know that there are 2 more international transactions. So can he consider that transaction also? Answer is yes. So if any transaction comes to knowledge of the TPO during that proceeding, in that case TPO can consider that transaction also, no problem at all. And after the TPO will prepare his order, and that order will be sent to the assessee as well as the assessing officer. Now question is that a TPO order will be the binding to assessing officer or not? Answer is yes, because TPO is a master in transfer pricing. So obviously TPO order will be binding to the assessing officer. Assessing officer has to follow the TPO order. Now question is that when TPO shall pass the order? So TPO has to pass the order before at least 60 days of the time limit of completion of assessment. So whatever time limit of the completion of assessment with the assessing officer, before that, at least before 60 days, TPO has to pass his order. You got my point or not? Yes. Now next part is that suppose if TPO proceeding is stayed by any court, or there is a time there is a some reference was made to like any foreign authority, or under section 90, if we want to information from any like a foreign authority and all, and there is a some time lost in that proceeding, then whatever time lost in that proceeding or due to the stay order of court, in that case that time will be extended. That time will be extended means TPO will get the extra time. You got my point or not? Yes. Now next part is there is a one amendment here, and this amendment says that in future government will issue one notification, and as per that notification, that TPO work will also be faceless. Means TPO will be faceless. Nowadays assessment is faceless, but TPO will be faceless in the future. So regarding that, government may come with a notification, and that notification will be issued till 31st March 2022. So till 31st March 2022, government will come with the notification, and as per that notification, the TPO work will also be faceless in future. Next part is related to the safe harbor rules. Now, what is the meaning of safe harbor rules? Safe harbor rules are basically a rules, like CBDT may come with some rules, and as per that rules, whatever price disclosed by assessee, if that assessee disclose the price in some limit or as per some rules, in that case department will accept that price. Nowadays, like safe harbor rules was there, but for your examination till now safe harbor rules is not notified. It means that safe harbor rules is not applicable for your examination. Now safe harbor rules means government will give some rules, and according to that rule, suppose they are saying that in case of software development service, just disclose the 18% profit, and assessee disclose the 18% profit. In that case, department will not argue that. Department has to accept that. That is called safe harbor rules. And there is one amendment from this year, as per section, for the purpose of section 911. 911 is basically income deemed to be accrued or arise in India in case of business connection and all, if non-resident is having some income from India due to business connection and all. So for that purpose also, like government may come with the safe harbor rules. So safe harbor rules, but for your examination there is no safe harbor rules, so don't worry about that. Till now there is not, like safe harbor rules are not notified, so you can ignore this part. Now next part is section 92D, that is maintenance of information and document. Guys, this section says that if transfer pricing is applicable, transfer pricing is applicable normally in case of international transaction, but in case of some domestic transaction also transfer pricing may apply. So transfer pricing is applicable, then you have to maintain the TP study report, that is called local file. Normally it is called as local file. You have to maintain the local file. But whenever income tax department asks about that local file, TP study report, you have to submit that TP study report to the department within 30 days. And you may ask for the extension also, and they can give you the extension for 30 days also. Now question is that some constituent entity also required to maintain the master file. Now what is the master file? We will discuss later. Now if suppose assessee not maintain the documentation, means TP study report, then what will be penalty and all, that we will discuss. But question is that, sir, is if suppose there is a one small international transaction between associate enterprise, then also assessee is required to maintain the TP study report? Answer is no. Guys, TP study report, or in simple word I can say that the documentation, that TP study report local file, the documentation is required to maintain only if your international transaction is more than 1 crore. If your international transaction is not more than 1 crore, then there is no need to maintain the TP study report. And guys, this TP study report you have to maintain for 8 years from the end of the relevant assessment year, means you have to cap that documents for the 8 years from the end of the relevant assessment year. Next section is 92E. 92E is related to the report of chartered accountant. Guys, whenever transfer pricing is applicable, then you have to take one audit report from chartered accountant in the form of the 3CEB. You know that there is a one form that is 3CEB. So in the 3CEB form, you have to take report from chartered accountant, and this report has to be submitted to department up to 31st October of assessment year. Suppose in your book, if it is mentioned 30th November, just change it. It is 31st October of assessment year, means CA report in the form of 3CEB has to be furnished to the department up to 31st October of assessment year. You got my point or not? Yes. Next part is the penalties in the transfer pricing. So first section is 271AA. Now section 271AA says that suppose if assessee fails to keep or maintain any information documents as per section 92D. 92D is a documentation, that is transfer pricing report. So suppose TP study report, assessee has not maintained the TP study report. In that case, there will be a penalty under section 271AA, and that penalty amount is 2% of the transactions value. So whatever your international transaction or specified domestic transaction, if transfer pricing is applicable in the specified domestic transaction, so whatever your 2% of transaction value, that will be your penalty if assessee has not maintained TP study report. Now second is fails to report the transaction. Suppose assessee has not reported an international transaction. He entered into some transaction, but he has not reported that transaction. In that case also 2% of transaction value is penalty. And third is fails to maintain or furnish correct information and document. Means he has maintained and submitted documentation, that is TP study report, but he has not correctly maintain or submitted information and documents. Means he has not, like, he maintained or submitted incorrect information and document. In that case, that penalty will be the 2% of transaction value. So all people just pay attention. Section 271AA. 271AA says that in 3 cases your penalty amount will be 2% of transaction value. First, assessee fails to maintain documents. Second, he has not reported some transaction, and third, he has not maintained or submitted correct information and document. In that case, 2% of transaction value will be penalty. One more point, section 271AA only says that suppose if assessee not maintain the master file, in that case your penalty amount will be the 5 lakh rupees. 5 lakh rupees is the amount of penalty in case of master file. Assessee fails to maintain the master file. Now next part is 271G. 271G says that if assessee not furnish the information and document, because assessee has to maintain information and document, he has to maintain the TP study report, and whenever income tax department asks for TP study report, he has to submit that TP study report to the department. But suppose assessee fails to submit that TP study report, in that case your penalty will be the 2% of transaction value. Now next part is a 271BA, that is suppose if you have not submitted the CA audit report in case of transfer pricing in the form number 3 CEB. So assessee fails to submit the audit report of chartered accountant in form of 3 CEB. In that case, penalty amount will be the 1 lakh rupees. Penalty amount will be the 1 lakh rupees. So always remember that audit report is not submitted. In that case, 1 lakh rupees penalty. Now there is a one section 270A. 270A says that is the misreporting or underreporting of income penalty topic from DT part. So failure to report any transaction would constitute a misreporting of income. So suppose if you have not recorded any transaction, means fails to report any transaction, in that case that 200% of the taxes, that penalty, misreporting or underreporting or penalty, and underreporting is due to misreporting, in that case 200% of taxes, that penalty is applicable. Now guys, suppose if any person is not reported any international transaction, in that case 2 penalty will apply. One is the section 271AA, that is 2% of transaction value, and second is this 200% of taxes, that 271, this 2 penalties apply. But guys, remember one thing, suppose assessee submitted the document, means he maintained the TP study report, he submitted the document, and transfer pricing officer increase the income. Means transfer pricing officer just calculated arm length price, and transfer pricing officer just increase the income, then it won't be treated as under reporting or misreporting. You got my point or not? Yes, but this is applicable only when assessee disclose all all material fact. All material fact assessee disclose. Assessee already filed the TP study report, assessee disclose all the transaction, but due to some reason, suppose assessee was following CUP method, but here TPO think that RPM should be applied, and in that case if income is increased, it won't be treated as underreported or misreported income. You got my point or not? Yes. Now we are going to start with one very interesting part, that is section 92CC and 92CD. So there are two sections, 92CC and 92CD is related to the APPA. APPA means advanced pricing agreement. Advanced pricing agreement. So guys, you just tell me one thing. In transfer pricing, there will be always a number of dispute will be high or less. Answer is obviously there will be a huge disputes in the transfer pricing, because transfer pricing itself is a very complex issue in the market. So obviously in transfer pricing, chances of dispute will be higher, because always assessee will say the CUP method is applicable, but department will say no, TNMM is applicable or cost plus method is applicable. So obviously there will be more dispute in case of transfer pricing. So there is one concept is called advanced pricing agreement. Advanced pricing agreement is basically agreement between assessee and department. Department means here CBDT. So there will be an agreement between department and assessee, and they both will decide that for assessee's case how arm length price will be calculated. Means which method will be applicable, cup method or RPM or TNMM, or which method will be applicable. They will sit together and they will decide. That is called advanced pricing agreement. Now, obviously, if there is an agreement, then obviously they have to follow the agreement. SSC has to follow the agreement. Department has to follow the agreement. In that case, dispute will be very less. That concept is called advanced pricing agreement. So question is that, sir, who can enter into the agreement? Or any person, if you are entering into any international transaction, then you can ask CBDT to enter into the agreement, and CBDT think that in that case, CBDT may enter into the agreement with any person with the approval of central government. So here CBDT will take the approval of central government, and after taking approval from central government, CBDT may enter into the agreement. Now question is that, okay, sir, this agreement or APPA is entered for the purpose of determination of arm length price in case of transfer pricing, or determination of income of non-resident as per section 911. This part, that income as per section 911, this is added by this year only. That 911 is, that is income deemed to be accrued or arise in India, means what amount of income deemed to be accrued or arise in India for non-resident. For determination of that income also, like SSC may enter into the APPA with the CBDT. You got my point or not? Yes. But for this particular purpose, they will, like, you know, that notified the manner, they will notify the, in the future they will notify the rules and all, but till now they have not notified. So just you have to remember that, till now you have to remember that, okay, you can enter into the APPA for the determination of your arm length price related to transfer pricing. Now always just remember that, sir, in that APPA, what CBDT will write? So CBDT will mention which method is applicable. Suppose cup method or RPM or TNMM or PSM, or which method is applicable, they will mention. Or they will give the manner of computation of arm length price. They may include that any method out of 5 method, or they may include any other method also, or they may include that any method out of that 5 method with some modification, alteration and all. So they will like mention in the agreement how your arm length price will be calculated. You got my point or not? Yes. Now question is that, okay, sir, APPA is applicable for all type of transaction, means you are entering into some domestic transaction, then also can you ask for the APPA? Answer is no. APPA is applicable only if SSC is entered into international transaction. Means APPA is applicable only for international transaction. For domestic transaction, APPA is not applicable. One more point, APPA is applicable for maximum 5 consecutive years. Can you enter for APPA for 3 year? Answer is yes. For 4 year, answer is yes. For 5 year, answer is yes. 6 year, answer is no. Means consecutive 5 year APPA is applicable, but after 5 year also you can go for the renewal and all, but maximum APPA is applicable for 5 year. You got my point or not? Yes. Now question is that APPA is binding or not? Answer is yes. APPA is binding to SSC who applied, as well as the CBDT, as well as the income tax department up to the level of the CIT, PCIT. So in simple word, I can say that APPA is binding to SSC as well as the income tax authority up to the level of the CIT, PCIT. One more point, suppose in future if there is a change in law or fact, then APPA is not binding. In future, suppose if there is a change in law or fact, in that case APPA is not applicable. One more point, suppose after some time CBDT comes to know that you have taken the APPA, and you misrepresented some fact, means due to the misrepresentation of fact or fraud, means you have taken the APPA through fraud and all, through fraud or misrepresentation of fact. In that case, CBDT has the power. CBDT, with the approval of central government, they may declare that APPA is void ab initio. Means CBDT comes to know that you have taken the APPA with fraud or misrepresentation of fact. They may declare that APPA is void ab initio with the approval of central government. And if APPA declare void ab initio, then all normal income tax provision will apply. And whatever time lost from the date on which you enter into APPA till the date on which that APPA declare void ab initio, that time will be extended. Means assessing officer will get the extra time for completion of assessment and all. You got my point or not? Yes. And guys, whenever APPA is applicable, then section 92C and 92C. Yes, people, sorry, there was some issue with the camera. Okay, so what I am saying that APPA is applicable for maximum 5 years, and if APPA apply, then section 92C and 92CA is not applicable. 92C is related to computation of arm length price, that 5 method and average and that 3% tolerance band and all, that is not applicable. As well as 92CA, that reference to TPO, that is also not applicable if APPA is applicable. Now guys, just pay attention, there is one very interesting part. And this part says that all people just pay attention. What I explained that APPA is applicable for maximum 5 years. But there is a one concept of rollback. Now what is the meaning of rollback? All people just pay attention. Suppose SSC entered into the APPA for the previous year 2021, 21, 22, 22, 23, 23, 24 and 24, 25. So this 5 year is covered in the APPA, that is the main APPA. Now there is a one concept is called rollback. Means assessee may ask for the rollback also. Now rollback will be for the 4 years before the first year of APPA. Means 4 year before the first year of APPA. It means your previous year 1920, your previous year 1819, your previous year 1718 and your previous year 1618. This 4 year can be covered in the rollback. Now rollback means 4 years before the year that is mentioned in the APPA, first year in the mention in the APPA, before that year 4 year is called your rollback year. But guys, this rollback provision is applicable with certain condition. Means you can make an application for rollback year only if whatever transaction you are entering into this year, that similar transaction was and that particular 4 year. Means in the earlier rollback year also you were doing the same activity, similar transaction was entered. In that case you can apply for APPA for this rollback year also. So in simple word, can I say that you can apply for the APPA for maximum 9 year? Can I say that you can apply for APPA for maximum 9 year? 9 year means 5 year is your main APPA, and after that suppose earlier also that transaction was similar. In that case this 4 year also you can cover in the APPA. This is known as the rollback year. This is known as the rollback year. Now all people just pay attention, very interesting part. First we will conclude the section 92 CD. After that I will discuss certain notification circular related to the rollback. So all people just pay attention. There is one section 92 CD. 92 CD say that all people just pay attention. Suppose for an example, there is a one assessee, name is a BB Limited, and BB Limited enter into the APPA. Now in BB Limited covered this year, that is 2021 till 24-25, this 5 year, and also we applied for rollback. So also like a rollback year is also like covered. Now suppose we made the application today, in this particular year we made the application. Question is that, okay, CBDT will sign within some particular time. Is there is any time limit to sign the APPA and all? Answer is no, there is no time limit. So many times what happens, CBDT may sign the APPA after 2 years also. Here what happened in this particular case, suppose CBDT signed this particular APPA in this year, that is on 16 July 2022, they signed the APPA. But APPA will be applicable from previous year 2021 only, means from the year in which application was made. But CBDT signed the APPA on 16 July 2022. So guys, now question is that, okay, whatever written earlier filed by assessee as per normal provision, because on 16 July 2022 they signed the APPA. So obviously for previous year 21-22 return is still not filed till 16 July 2022. But guys, you already filed the return of 2021, 19-20, 18-19, 17-16, 17-18 and 16-17, means earlier year return was already filed. And that earlier return was filed as per the normal provision of income tax. Now APPA is applicable for that year. Then guys, you have to file the modified return. You have to file the modified return for this particular year, and modified return has to be filed within 3 months, or it is 3 months from the end of the month in which APPA was entered. Means you have to file the modified return of those years for which APPA is applicable, and you already filed the return. Then you have to file the modified return in accordance with the APPA within 3 months from the end of the month in which APPA was entered. But sir, guys, all people just pay attention. There may be a question. Okay, sir, suppose for this year, some years assessment was already completed. Assessment was already completed and all. Then what will happen? Assessing officer will do the reassessment. Means he will modify the earlier assessment. And he will modify the earlier assessment within 1 year from the end of the financial year in which modified return was filed. So what I am saying that if assessment was already completed, in that case assessing officer will modify that assessment within 1 year from the end of the financial year, 1 year from the end of the financial year in which modified return was filed. But suppose if assessment is pending, so in simple word I can say that obviously that future year assessment is pending. So assessment is pending for the future year. In that case assessing officer will get the 1 extra year. Means suppose as per section 153(1), Time limit to complete the scrutiny assessment is 12 months from the end of the relevant assessment year. That 12-month time will be the 24-month. 12-month time will be increased by 1 year if that assessment is pending for those year. You got my point or not? Yes. Now all people just pay attention. We are going to discuss something, some issues related to the rollback. All people just pay attention. Now whatever I am going to discuss for next 3-4 minutes, that is only for rollback. Rollback means this 4 year. Rollback means this 4 years. So we are going to discuss about the rollback. All people just pay attention. Now guys, question is that, sir, we can make an application for rollback? Answer is yes. But sir, question is that, suppose assessee don't want to take APPA, means assessee don't want APPA. He want only rollback. Is it possible or not? Answer is no, it is not possible. Means rollback is optional. Rollback is optional. If you are taking APPA, means suppose you have taken the APPA, means you sign the like assessee and department sign the APPA. In that case, rollback is optional. Means you want rollback or not, what that depends on you. But you cannot do that in a such a way. You are taking just accepting the rollback, but you don't want to take the APPA. Then it is not possible. In simple word, without marriage, is like children is possible? Answer is no. First you have to do the marriage. So marriage is APPA. Now children are optional. Means rollback is optional. You want children or not, that is the optional. So here you cannot take only rollback without taking the original APPA. You got my point or not? Yes. Now one more point. Sir, question is that, okay, sir, you are saying that rollback is applicable for this 4 years. So is we need to make an application for all 4 years, or we can select also? Like we want only for 16, 17 and 19, 20. Is it possible? Answer is no. You have to make an application for all 4 years. Means you can take the rollback for all 4 years. There is no option to choose the year. But guys, there are some exceptions. Suppose if in any year there is no international transaction, then obviously for that year rollback is not possible. In simple word I can say that, suppose in 17-18 year there was no international transaction, so for 17-18 rollback is not possible. Means there is no need to apply for the 17-18 because there was no like international transaction. Or suppose for any year you have filed the late return, then also rollback is not applicable. Means you filed the belated return, then rollback is not possible. Means rollback is possible only if you file the return on the time. So for any year, suppose if you have not filed the return on the time, in that case, for that year rollback is not available. One more thing. Suppose for any year that CA report 3CEB form that has not filed. So CA report 3CEB form not filed, then for that year also rollback is not possible. You got my point or not? Yes. Now one more point, very interesting. They are saying that due to rollback, obviously for rollback year, that APPA will apply for rollback year, and due to rollback, your income should not be less than written income. Means if your income is less than written income due to the rollback, in that case for that year that rollback is not applicable. It means, I can take one example, means it should not be less than written income, but it can be less than the like assessed income. I can take one example. What happens? Suppose assessee filed the return and as per return of income, your income was 50 lakh. Now suppose for that year rollback is applicable. Now as per rollback means as per APPA, your income down to 40 lakh. Means your income goes income reduced to 40 lakh. Question is that, is rollback is applicable? Answer is no. Your income should be 50 lakh only. Means due to APPA in rollback, your income should not be lower than written income. But guys, what happens? Suppose your written income was 50 lakh. But assessing officer made the assessment and assessed income is 70 lakh. Now in rollback, due to rollback, your income comes to the 60 lakh. Is it rollback is applicable or not? Answer is yes. In that case, rollback is applicable. You got my point or not? Yes. One more point. Suppose if any issue was pending with the ITAT, that is Income Tax Appellate Tribunal, and ITAT already decided that fact. ITAT already concluded that particular matter, then for that particular matter, rollback is not applicable. What I am saying that if a case was pending with the ITAT and ITAT already concluded that matter, in that case for that particular matter, rollback is not applicable. You got my point or not? Yes. Now all people just pay attention. There are two interesting like 2 points from the circular. There are two interesting points also. All people just pay attention. Suppose there is a one company, name is a Sai Limited. And there is a one company, name is a Shirdi Limited. There were two companies. Now Sai Limited is amalgamated with Shirdi Limited. Sai Limited amalgamated with the Shirdi Limited, and new company continue as Shirdi Limited. New company continue as Shirdi Limited. Now suppose This Shirdi Limited in current year only, they like merge, Sai Limited is merged with the Shirdi Limited. So now there is only one company, that is Shirdi Limited. Now suppose Shirdi Limited is going for Appa and they enter into Appa. Can they take the rollback also or not? Means rollback provision is applicable or not? Answer is yes, because now it is a Shirdi Limited. Earlier Shirdi Limited was in existence. Answer is yes, so they can go for the rollback. Now all people just pay attention. Second example. Suppose there is a one company name is A Limited. There is one more company name is a B Limited. Now AB Limited is merged and they made one new company, and that new company name is a C Limited. Now suppose C Limited applied for the APPA. Question is that can they go for the rollback? Answer is no. A rollback provision not applicable because C Limited is now in existence, but earlier C Limited was not in existence. Earlier A and B company was there. So here C Limited, here C Limited can apply for APPA, but rollback is not applicable. Rollback is not possible because earlier C Limited was not in existence. You got my point or not? Yes. Now one point related to the demerger. Suppose there is a one company name is a Titan. Now Titan, there is a demerger and there are two companies. One is the Titan and one is the Tanishq. Now what happened? Titan Limited is applying for APPA. Question is that can they apply? Answer is yes. Can they apply for rollback? Answer is yes. Rollback also they can apply because earlier that Titan Limited was in existence. Now Tanishq Limited apply for APPA. Answer is yes. But can they apply for rollback? Answer is no, because Tanishq Limited was not in existence. So in simple word I can say that assessee applied for APPA. If they that assessee same assessee was existence in rollback year, then only they can apply for rollback. Otherwise rollback provision is not applicable for that particular assessee. You got my point or not? Yes. So this is the completion of part rollback. Yes people, now next concept is related to secondary adjustment, but before studying secondary adjustment we have to understand the primary adjustment. Sir, what is the meaning of primary adjustment? So all people just pay attention. We are going to take one example, you will able to understand, don't worry about that. So first is a primary adjustment. Primary adjustment means suppose in India there is a one company name is a BB Limited. And in USA we have one associate enterprise name is suppose KK Limited, that is associate enterprise. So BB Limited and KK Limited both are associate enterprise. Now what happened? Suppose we sold some goods to the KK Limited and our selling price of that goods is 5 crore rupees. Means 5 crore rupees is our international transaction price. But similar goods we sold to one more foreign enterprise name is suppose Sunny Limited. We sold similar goods to the one more foreign enterprise name is a Sunny Limited, and in that case our transaction value is 7 crore. So can I say that this 5 crore is not a true price? Our arm length price should be 7 crore because we are selling to our associate enterprise, we are charging only 5 crore. But when we are selling to outsider, we are charging 7 crore. So in simple word I can say that arm length price is 7 crore. So what will happen in this particular case? Obviously in our income 2 crore rupees will be added. In our income, means in income of the BB Limited, that 2 crore rupees will be added, means difference between arm length price and actual transaction price. That 2 crore will be added to our income due to the arm length price. Now this is known as the primary adjustment. This is known as the primary adjustment, means when you add your arm length price, difference between arm length price and actual transaction price, and that amount is added to your income, that is called your primary adjustment. Now guys, when we made the sale of 5 crore to the KK Limited, our associate enterprise, obviously we collected only 5 crore from the foreign enterprise. Means 2 crore rupees money is still with the foreign associate enterprise. So I can say that this 2 crore rupees is still with the associate enterprise. So here Nirmala Sitharamanji says that all people just pay attention. Okay, whatever this 2 crore is known as the excess money. I can say that this 2 crore we have to repatriate in India within 90 days. Now this 90 days will be calculated from which date, that we will discuss later. What I am saying that this 2 crore rupees have to repatriate in India. This 2 crore we have to bring into the India within 90 days from some particular date. Otherwise it will be assumed that we have made a loan, means we have given the loan of 2 crore to our associate enterprise, and interest on this 2 crore will be added to our income every year till the time we repatriate that 2 crore rupees from our associate enterprise. What I am saying that all people just pay attention. So difference between that 5 crore and 7 crore, so 2 crore is added to our income, that is called your primary adjustment. Now this 2 crore is with our associate enterprise, we have to repatriate that 2 crore in India within 90 days. Suppose we have not repatriated that 2 crore within time limit, in that case it will be assumed that we have made the loan to our associate enterprise and interest income on that loan will be added to every year till the time of repatriation of that money. You got my point or not? Yes guys, that is known as the secondary adjustment. Now question is that, sir, secondary adjustment, when secondary adjustment is possible? So all people just pay attention. Secondary adjustment is possible only if the primary adjustment made due to 5 reasons. Means primary adjustment at 5 times due to 5 reasons, then secondary adjustment is applicable. First case, when assessee himself suo moto made the primary adjustment. Means suppose our actual sale price was 5 crore, in return we disclose that arm length price is 7 crore, so assessee himself suo moto he made the primary adjustment. Second, if assessing officer determined the arm length price and due to determination of assessing officer, due to the order of assessing officer and that is accepted by assessee, if there is a primary adjustment, then secondary adjustment is possible. Third, suppose a primary adjustment is due to advance pricing agreement. Means assessee entered into the APPA and due to APPA if there is a primary adjustment, means due to APPA if your income is increased, in that case secondary adjustment is possible. And suppose a primary adjustment is due to the safe harbor rules. Or last, suppose a primary adjustment is due to the MAP, that is mutual agreement procedure. Now question is that what is the meaning of the MAP? What is the meaning of the mutual agreement procedure? So mutual agreement procedure means, just I am taking one example, just understand that. Suppose I am having some income from associate enterprise and my associate enterprise is located in Mauritius. And like Mauritius and India is having some DTAA. But Mauritius is not giving DTAA benefit to me. Mauritius should give the DTAA benefit to the BB Limited, but Mauritius is not giving the DTAA benefit. Then what I will do, you know that I will request to the Indian Income Tax Authority, that is competent authority. Just understand by competent authority. So I will request to competent authority of India that Mauritius is not giving the benefit of DTAA. Then Indian competent authority and Mauritius competent authority, they will sit together and after that they will decide, they will issue one MAP, that is mutual agreement procedure. They will make one MAP and they will give the resolution to the BB Limited, that is called MAP. So through MAP, due to MAP, if there is any primary adjustment, then secondary adjustment is possible. Now question is that, sir, you are saying that excess money, whatever with the associate enterprise, we have to bring that excess money in India within 90 days. Sir, can we bring that excess money, can we repatriate that excess money from any other associate enterprise or not? Answer is yes, you can repatriate, no problem at all. Means suppose I sold goods to the KK Limited associate enterprise, but suppose it's not possible for me to repatriate that money from KK Limited, but I am having some other associate enterprise, that is the Lobo Limited in the Mauritius. Then can I repatriate that money from that associate enterprise? Answer is yes. Means you can repatriate that 2 crore from any of your non-resident associate enterprise. You got my point or not? Yes. Now next part is, sir, that excess money has to be repatriated in India within 90 days, but that 90 days will be calculated from which date? So first, suppose a primary adjustment is due to the order of assessing officer or appellate authority. Means order of appellate authority or assessing officer, then from the date of order. From the date of order means after the date of order normally. So from the date of order, you have to repatriate that money within 90 days. What I am saying that primary adjustment is due to the order of assessing officer or like appellate authority, then from the date of order within 90 days, you have to bring that money into the India. Suppose primary adjustment is due to the APPA. Primary adjustment is due to the APPA. APPA means advance pricing agreement. Now guys, due to the APPA, if there is a primary adjustment and APPA is entered on the date on which APPA is entered, on that date, if due date of return filing is still pending, means due date of return filing is still pending, then 90 days will be counted from the date of actual filing of return. 90 days will be counted from the date of actual filing the return, means whenever you will file the return, from that date within 90 days you have to repatriate the money. But suppose due date of return filing of that year is already expired. Due date of return filing of that year is already expired. In that case, you have to repatriate that money within 90 days from the end of the month in which APPA was entered. What I am saying that within 90 days from the end of the month in which APPA was entered. You got my point or not? Yes, all people just pay attention. All people just pay attention. I am just taking one example. You will able to understand. All people just pay attention. Huh? All people just pay attention. Huh? All people just pay attention. We are taking one example related to APPA. So suppose for an example, APPA is entered for previous year 1920, 2021, 21-22, 22-23 and 23-24. Suppose this 5 years are covered. Now suppose APPA is signed on 19 July 2022. So APPA is entered or signed on 19 July 2022. Can I say that on this particular date, like previous year 21-22 and 22-23, 23-24, this 3 years return is still return filing due date is pending, because previous year 21-22 due date of return filing will be the 30th November. So 30th November is still pending on 19 July 2022. Then if there is a primary adjustment of this 3 years, then you have to repatriate that money within 90 days from the date of filing, means within 90 days from the actual date of filing of return, means whenever you will file the return, within 90 days you have to bring that money into the India. But guys, for this particular 2 years, your date was already expired. For this particular 2 years, your date was already expired. So you have to repatriate that money in India within 90 days from the end of the month in which APPA was signed or APPA was entered. So APPA entered in the month of the July. So July end will be 31st July. So after that, within 90 days, you have to bring that money into India. You got my point or not? Yes. One more point. Suppose if suppose if that primary adjustment is due to the MAP means mutual agreement procedure. In that case, you have to bring that money into the India within 90 days from the date of giving effect of MAP by the assessing officer. Means whenever AO will give the effect of that MAP from the date of effect within 90 days, you have to bring money into the India. Now guys, one more thing. Suppose if primary adjustment is due to any other reason means either suo moto or due to the safe harbor rule and all. In that case, that money has to be repatriated in India within 90 days from the due date of return filing. Within 90 days from the due date of return filing as per section 139(1). Now all people just pay attention. Suppose money is not repatriated within 90 days. And money repatriated after 90 days. Suppose in 95 days money is repatriated. So here question is that interest will be applicable for only 5 days or total 95 days. Right answer is total 95 days. Always remember that if money is not repatriated within 90 days and suppose money repatriated within 95 days, then interest will be applicable for total 95 days. Here there is one interesting part, and this part says that suppose if primary adjustment is made by the AO or appellate authority, then money is not repatriated within 90 days from the date of order, then interest will be applicable from the date of order. So interest will be applicable from the date of order. You got my point or not? Yes. Now next second part. Suppose APPA was entered and primary adjustment is for the year for which due date is still pending. Here due date is still pending for this 3 year. So due date is still pending means in that case you have to repatriate that money from the date on which you file the return within 90 days. Suppose within 90 days money is not repatriated, then interest will be applicable from the due date of return filing of this year. Here there is one difference, because money you have to repatriate it within 90 days from the date of actual filing of return. But suppose you have not repatriated, then interest will be applicable from the due date of return filing. Interest will be applicable from the due date of return filing. And suppose that due date of return filing is already expired, then you have to repatriate it within 90 days from the end of the month in which APPA was entered. If not repatriated, then interest will be applicable from the end of the month in which APPA was entered. You got my point or not? Yes. And if it is due to the MAP, in that case, whenever AO will give the effect of MAP from that date, that interest is applicable. And due to any other reason, in that case, interest will be applicable after the due date of return filing. So due date of return filing will be 30th November, means after 30th November interest will be applicable. You got my point or not? Yes. Now question is that, sir, what will be the interest rate? What will be the interest rate? Because you are saying that every year interest income will be added. So what will be the interest rate? So interest rate depends on your transaction was denominated in Indian currency or foreign currency. Suppose your transaction was denominated in Indian currency. Indian currency means rupees. In our example, 7 crore, 5 crore, that was Indian rupees, Indian currency. In that case, your rate will be whatever SBI 1 year lending rate as on the 1st April of previous year. Means previous year for which income is included, previous year for which interest is calculated basically. So I can say that suppose transaction was denominated in Indian currency, then your interest rate will be the whatever SBI 1 year marginal lending rate as on 1st April of previous year plus 3.25%. Suppose SBI rate is a 9%, then you have to add 3.25, so it comes to the 12.25%. You got my point or not? Yes. But suppose if the transaction was denominated in foreign currency, in that case you have to take the LIBOR of 30th September of previous year. LIBOR as on 30th September, of previous year plus 3%. You got my point or not? Yes. Now guys, all people just pay attention, very interesting part. This primary adjustment and secondary adjustment, basically the secondary adjustment is applicable only if your primary adjustment is more than 1 crore. Means if primary adjustment is up to 1 crore, in that case secondary adjustment is not applicable. One more point. If primary adjustment is related to assessment year 17-18 or afterwards, then only secondary adjustment is applicable. In simple word, I can say that primary adjustment is for assessment year 17-18 onwards, and primary adjustment is more than 1 crore. Then only you are required to do the secondary adjustment, otherwise secondary adjustment is not required. Now there is one more interesting part. Last year what happened? Like many company requested to finance ministry that it is not possible to repatriate money from associate enterprise. How we will repatriate money from associate enterprise and all? Sir, give some option, because otherwise every year interest income will be added. So give some options. So here Nirmala Sitharamanji given one some option, and Nirmala Sitharamanji says that, okay, do one thing, just pay 18% tax. Just pay whatever your excess money on that non-repatriated amount, just pay 18% tax, and 18% should be always be added with 12% surcharge and 4% health and education cess. That is the 20.9664%. Means this 20.9664%, this 20.9664%, just pay the tax, that is 20.9664%, and after that we will not add the interest income. You got my point or not? Yes. So there is a one option, okay, if it is not possible for you to repatriate money, then just do one thing, whatever non-repatriated money or balance amount, on that just pay the tax at the rate 20.9664%. In that case there is no need to repatriate money from foreign. You got my point or not? Yes. Just read that, you will get it. Okay. Now next part is 94A. 94A is a special provision for the transaction with the person located in NJ. NJ means notified jurisdictional area. Now you know that there are various countries, they are not cooperating with India on the information sharing. Means they are not supply the black money holder information if black money is kept in that particular country. Like example is a Switzerland and Cyprus and all, that is called that type of country, they are not cooperating with India. Then what we can do, you know that our central government has the power, okay, we can declare that country as a NJ, that is notified jurisdictional area. Till now we declared the NJ, that was only like we declared one country as NJ, that was name was Cyprus, that is Cyprus or Cyprus, but after some time we removed that. So today there is no NJ, no notified jurisdictional area. But suppose if any country is declared as NJ, then what will happen? So guys, suppose if any country is declared as NJ, and if you are doing any transaction with the person located in that country, in that case that transaction will be treated as deemed to be international transaction, and transfer pricing provision is applicable. So suppose I can take example, for an example, like Cyprus is a NJ, and we are purchasing one machine from NJ, that Cyprus, from person Mr. Sunny. So Sunny and BB Limited is not a related party. We are not holding the 26% or more equity shareholding and all. Then also we both will be treated as associate enterprise, and transfer pricing provision is applicable. We both will be treated as associate enterprise, and transfer pricing provision is applicable. All transfer pricing provision is applicable except that 3% tolerance band. Means that plus minus 3%, 1%, that tolerance band provision is not applicable. All other provision of transfer pricing is applicable. One more thing. Suppose we taken the money from person located in Cyprus. In Cyprus there is one company name is a Lobo Limited. Suppose Lobo Limited invested in our company BB Limited. Then here BB Limited have to explain that, okay, what was the source of money in hands of Lobo Limited. Means Lobo Limited earned that money from where? We have to explain to Indian Income Tax Authority, and suppose we are not able to explain or our explanation is not satisfactory, in that case, that whatever money we received, that money will be treated as our income and it will be taxable. It will be treated as our income and it will be taxable. One more point, whenever we will make the payment of any person located in NJ and TDS is applicable, then we have to deduct minimum TDS of 30%. Means minimum TDS 30% we are required to deduct. You got my point or not? Yes. Now next part is a section 92BA, that is a specified domestic transaction. There are some domestic transaction also where transfer pricing is applicable. But in case of, just you have to remember that in case of domestic transaction, transfer pricing is applicable only if that specified domestic transaction value is more than 20 crore. Means the specified domestic transaction value is more than 20 crore. In that case only this provision is applicable. Otherwise transfer pricing is not applicable. Which type of transaction? Whether that transaction is mentioned in 80IA subsection 8 or 10 or 80A or under chapter 6A or under 10AA, on for which 80IA 8 and 10 is applicable, or any business transaction between the person referred in section 115 BAB subsection 4. BAB subsection 4 is the, like suppose one company is opting that 15% and they are like some related party, they are purchasing and selling at some value and they are earning the higher profit and all. In that case, if that transaction value is more than 20 crore, then transfer pricing is applicable. Obviously it is not possible to remember, just you have to remember that if that transaction value is more than 20 crore, in that case only transfer pricing is applicable. After that, there is one point, that is country by country reporting, or I can say that the CBC reporting. Just you have to read that CBC reporting as well as the master file. Just you have to read once, that's it. After that, there is one section 94B, and this section is a very interesting section and last section of your transfer pricing. Last section is 94 subsection B, that is called limitation on interest deduction of certain cases, or it is also known as the thin capitalization. This concept is known as the thin capitalization, or I can say that the interest limit. There is some limit. Your interest paid to the associate enterprise, that will be allowed only up to 30% of EBITDA. Means whatever you are earning before interest and taxes, depreciation and amortization, on that EBITDA, maximum 30% interest is allowed. So all people just pay attention. This section says that this section is applicable only to the either Indian company or any PE of foreign company in India. What I am saying that this section is applicable only to the Indian company or PE of foreign company in India. And suppose if they are taking any debt from non-resident associate enterprise, if they are just taking some loan or debt from non-resident associate enterprise and they are paying the debt charges. Suppose this Indian company or PE of foreign company, they are paying debt charges to the non-resident. Here debt charges means either that may be a interest expenses or guarantee commission, etc. That is called your debt charges. In that case, there is a limit. Means excess interest will be disallowed. There is a one limit and excess interest will be disallowed. Means in limit it will be allowed, but excess interest will be disallowed. Now question is that, sir, there is one amendment from this year, and this section says that suppose if this non-resident is having any P in India, non-resident is having any P in India, and if loan is taken from this P in India, and that P is engaged in the banking business, then this section is not applicable. What I am saying that, suppose if you taken the loan from non-resident, then this section is applicable. But non-resident is having P in India and P is engaged in the banking business. In that case, this section is not applicable. Suppose if you have taken the loan from that P in India. You got my point or not? Yes. Now question is that, sir, you are saying that excess interest is allowed. So question is that what is the meaning of excess interest? So guys, here excess interest means how to calculate the excess interest. Just pay attention. First take the total interest. Means whatever your total interest means interest to associate as well as non-associate. So just take the total interest minus 30% of EBITDA, and interest paid to associate enterprise, whichever is lower, that lower is known as the excess interest, and it will be disallowed. What I am saying that, just first how to calculate excess interest. So excess interest means total interest minus 30% of EBITDA, or interest to associate enterprise, whichever is lower, that lower is known as the excess interest, and it will be disallowed. But there is one alternative view. An alternative view says that just that 30% limit is applicable only to interest to associate enterprise. So whatever your interest to associate enterprise, out of that 30% of EBITDA, that interest is allowed and excess will be disallowed. That is one another views, but you have to follow this formula format only. Now question, all people just pay attention. Many times what happens, suppose you have not taken loan from your associate enterprise. but your associate enterprise given guarantee of that loan. Your associate enterprise gave guarantee of that particular loan, or your associate enterprise deposited similar amount, means deposited matching amount with that lender. In that case, it will be presumed that you have taken the loan from your associate enterprise. So in this particular case, suppose Indian company is a BB Limited, our foreign associate enterprise is a Sunny Limited. We have not taken loan from Sunny Limited, but Sunny Limited gave the guarantee of whatever we borrowed from one bank from foreign. If Sunny Limited provided the guarantee, or Sunny Limited deposited the matching amount in that particular bank, then it will be treated as that okay, we have taken the loan from our associate enterprise only, and this provision is applicable. One more point, this section is applicable only if your interest expenses for more than interest expenses to associate enterprise is more than 1 crore rupees in a previous year. Means interest is more than 1 crore, then only this section is applicable, otherwise this section is not applicable. One more point, guys, suppose whatever your excess interest, so what will happen with that excess interest? So excess interest will be carry forward for maximum 8 years. Excess interest you can carry forward for maximum 8 years, and in the future year, if that is fall within the limit, then you can claim as business expenditure. You got my point or not? Yes. One more point, this particular section is not applicable if assessee is engaged in banking or insurance business. Means this Indian company or PE of foreign company, if they are engaged in banking or insurance business, then this section is not applicable. This is the completion of transfer pricing topic. So just guys, you have to revise 3-4 times, and after that you have to solve the question, so you can easily understand this particular topic. So thanks a lot, people. Your examination is now only very few days are remaining for your examination. So guys, just study and study, give your 100%. Just avoid the negative people, negative thought and all. Always be, you should be a positive and positive approach, and just prepare for your examination. Thanks a lot, people. That's enough for today from my side. Thank you.